Well, Paul Muthaura, their Chief Executive Officer, Capital Markets Authority, joining us here to close the bell and, of course, mark the end of a trading year. Good evening and thank you very much for joining us. This is the Trading Bell. My name is O'Brien Kimani. We'll be joined later on by Samuel Gishohi, Business Development Manager at NIC Securities. And, of course, we'll be looking at the market in the year 2016. But for now, I engage Capital Markets Authority CEO Paul Muthaura. We basically want to find out how the year has been for the market and, of course, what they are doing to entrench discipline and good governance in the market. Well, it's nice to meet you. You too. Welcome to the Trading Bell.
Great
Please.
to see you.
From a market perspective, how would you sum up the year for you?
Well, I think it's been a year of both highs and lows for the market as well as for the authority. This is a year in which the authority has been recognized as the most innovative regulator on the continent for the second year running. It's the same year that we have been recognized as one of the top employers in the country. But we must be conscious that this is also a year where trading levels, market capitalization at the exchange have descended because of wider economic factors, both nationally as well as internationally. Mm-hmm. The global markets have seen a lot of ups and downs. With the end of the commodity super cycle, a lot of Africa has suffered quite significantly, and in that sense, Kenya has outperformed, especially in macroeconomic terms, and many of the other larger economies on the continent. Mm-hmm. So that's a positive. But as we look at opportunities for listings, opportunities for new debt issuance, the market has seen a fairly slow time on the back end of the occurrences of both Imperial and Chase Bank. It has introduced a level of, I think, market caution that has seen debt issuance come down quite some level, and has also seen trading depressed to some degree, but we're seeing very strong participation from international investors, which further reaffirms what a positive story Kenya presents for global investors and the genuine opportunity that Kenya really has positioned itself as one of the future financial centers of the world.
For you, it has been a mixed bag of chips, but I want to find out from you, what has kept you awake?
I think if you look at the authority, we have a dual mandate of both regulation and development. And on both those sides, we've been very active in this year. On the development side, we've seen very significant strides towards the launch of derivative markets in partnership with the Nairobi Securities Exchange. We are about to see the first exchange-traded funds traded. We saw the first real estate investment trust issued and traded in this year. And we are also seeing a lot of very positive strides with the legal framework, with the new corporate governance framework coming in place, with the new framework for derivatives markets coming into place, with the new anti-money laundering and counter-terror financing laws coming into place. So Kenya has progressed very well in terms of raising our standards in terms of global competitiveness. But we've also had significant challenges when it comes to enforcement. The authority has had quite a number of cases, both within our administrative actions as well as court matters. We continue to work particularly with the judiciary to try and accelerate the timeliness of conclusion of some of these matters so that we can certainly reinstill that confidence in people that where things seem to have gone wrong, there is a sense that they are addressed in a timely manner.
Well, we'll be discussing that, but I want to find out from you. In the markets value chain, we have the CDSE, or the Central Depository Corporation. We have the Nairobi Securities Exchange. We have the Capital Markets Authority. What is your role, briefly, in the value chain?
Now, as the authority, we are the licensing and oversight entity for the market. We give the Nairobi Securities Exchange their license. We also license the Central Depository and Settlement Corporation, as well as all the other players in the market. But in addition to that, and this is where the dual mandate comes in, we both regulate, so we supervise, we license, we approve, we inspect, but we also have a responsibility for working with industry towards introducing new products, promoting competitiveness of Kenya, and we are really at the forefront of working to develop or to actually now implement the 10-year capital markets master plan.
Good.
That was developed together with the whole industry. This is not, often it's misunderstood that the master plan is a CMA document. It's actually an industry document that was worked through in excess of a year, both industry locally and internationally, to come up with what is really the right blueprint to transform and grow Kenya's capital markets. Then how do we all work together to deliver on that?
Very well. One of your role is to police the market and see that each player is behaving and playing according to the rules. How are we ending up in a situation whereby we have a couple of listed companies engaging in boardroom misbehaviors, and yet we have CMA? How is this happening?
Well, you have to look at this at different levels. One, we have to remember there is a difference between licensed persons and listed persons. Very often, people ask, why isn't the authority doing to, for example, Uchumi, what central bank is doing to a bank? Those are fundamentally different relationships. Where you talk of our licensees, be it the exchange, an investment bank, a broker, we can intervene, we can take the kind of actions, we can have the level of intervention that can see us appointing board members or taking any other very drastic action because they're our licensee. Where an entity is a listed company, the role of the authority is to make sure that they are providing the right information in a timely manner to allow investors to make a decision. So if there are concerns around their performance, their returns, their potential weaknesses in governance, we are working to make sure that information is available in a timely manner so investors can make a decision whether they want to be in or out of that company. Now maybe just slightly further. Now when you look at the issues around corporate governance, now we set standards as to what should be best practices and governance standards. But those standards are, there's some that are mandatory and there are some that are best practice. And that's where there's some distinction, but we'll go into that.
Very well. Let's, for example, pick one case of Uchumi Supermarkets, which is a listed company. And, you know, from the forensic audit report that was conducted by E&Y, it is emerging, or it has emerged that, you know,
KPMG.
KPMG, not even EY. It has emerged that the company was cooking its books since the year 2014. How did these escape the eye of CMA?
Well, first and foremost, when you talk of financial statements, who is responsible for financial statements? It's the preparers. It's the chief finance officer, it's the chief executive, it's the board of an organization that put out information as to whether it is providing a true and fair picture. The second layer is the external auditor to come in to look at whether what that board is putting out is actually reflective and a true picture. And that information is then shared with the authority for us to do our own oversight, and we rely on the information that we've been given. If you would imagine that for every company we did a re-audit of every audited statement, no company would do business. So we rely on the preparers as well as the auditors to give us the information. It is where failures are identified, we then step in to take appropriate enforcement action. But we are not auditors.
Very good. I mean, you're not auditors, but you're also supposed to verify the information that you have been given by these companies so that you ensure and you counter-check that the information given to the shareholders or to the public is a true reflection of the company. Is it that you have failed in that mandate in the past?
Thank you for that question. It is, we do not verify the information. The auditors verify the information. We review and ensure that what is contained in that verified information is communicated to the public in a manner that it properly reflects that information. If these are audited accounts, we are ensuring that all the salient details of that audited account are made available to investors to understand. We are not going in to do a fresh audit of that information. It is only a situation where we are informed or circumstances are highlight that there were, in fact, failures in the manner in which either the financial statements were prepared or the audit was conducted, that we can then have powers to step in and re-audit or carry out a forensic audit to inquire into specific aspects of failure.
I mean, in the interest of time, because we have to wind up, I want to find out from you, has these boardroom issues, how have they affected the shareholders or the public?
No, fundamentally, the role of the board is to act in the best interests of both the shareholders and, to some degree, the wider stakeholders of the company. So where there are failures in governance by the board, it has an undoubted impact on the confidence of those investors, as well as the commercial interests of both the shareholders and those stakeholders. So part of the reason why you have a new corporate governance code is to introduce much more stringent requirements as to what are the activities or responsibilities that the board is expected to carry as it's carrying out that governance role. We have a new Companies Act, which is strengthening what are called the fiduciary responsibilities of those directors. So where they fail to conduct themselves appropriately, appropriate action is taken. There are the recent actions you've seen in the press, with the authority taking actions against specific individual directors where we've established that they failed to fully execute their responsibilities as a director of a public company.
And there are also proposals, flying that, you should even go further. And this is where, regulations should be strengthened so that you're given mandate to attach some of the properties or to freeze some of the properties of suspected individuals engaged in malpractices. Is this something that you're likely to pursue with the Treasury?
Now, as the law currently stands, where an individual is charged with an offense, then the authority, through the courts, can seek freezing orders for their assets. But in the world of natural justice, in the world of fair constitutions, you do not imagine someone has done wrong and proceed to freeze their assets. You must establish wrongdoing. Having established it, you charge them, and then you can proceed with freezing orders, which is already catered for in the law. We're just working with the judiciary to make sure that process can occur in a much more timely manner.
Well, in the interest of time, we have to come to the end of this very exciting interview.
Yes.
But finally, I want to find out from you, inside trading, what are you doing to ensure that it's not a common occurrence?
At two levels. One, we have fundamentally changed the law so that insider trading is now a strict liability offense. If you're an insider of a company and you trade, you're an insider trading, and it's now upon you to prove that you were not actually breaking the law or committing an offense. It's no longer for the authority to prove that you're carrying out that offense. We're also investing very significantly in new surveillance systems to improve our ability to track market activities. We're working very closely with the NSE to also build their own capacity as a frontline regulator to supervise market, to supervise trading, to make sure that we can minimize occurrences of insider trading.
What are your projections for the market?
I think when you look at 2013, the market really actually rose in a year of elections, which showed very strong signs of the stability and sustainability of our market. I think we continue to look for positive trends in that direction. We've come through a challenging year, and I think we expect the market and hope that the market will move up in the coming year.
Good. Thank you very much, Paul, for joining us here. Paul Muthaura, Chief Executive Officer, Capital Markets Authority, joining us here to help us understand the market and, of course, what they are doing to bring some sanity into the market. You're watching Trading Bell. Financial Markets is coming up next. And later on, I'll be joined by Samuel Gishohi, Business Development Manager at NIC Securities, to have a look at the markets. We say in business, figures do not lie. The figures for the Nairobi Securities Exchange, where the market has dipped by about 23.5% this year. Joining us on the set, Samuel Gishohi, Business Development Manager at NIC Securities. Thank you very much, Gishohi. When you look at the market, what conclusions do you make as we come to the end of the year 2016?
Well, we did predict earlier on in this year that it would be a contrarian investors market. Contrarians are people who tend to go against the grain. And we've been right so far. It's been a very, very difficult year, a roller coaster year, really. It's on the downside of the roller coaster, you know, because we had several hits. We've seen the market go to about 3,100, and that is really the lowest we've been since around 2014. And that has been because we've had several hits on the market. Markets tend to move on sentiment, on fundamentals, and several other external factors. And so we've really been hit by several factors over the year, and that has caused a very prolonged bear run. But right now we are in a buyer's market. So those investors who might be looking at it as a time to buy are really in a good position because they're buying discounted stocks.
Of course, there are four fundamental issues that have happened this year. Number one, the re-election or the US elections. Number two, the interest rate cap law that came into the market. Which fundamental do you think has altered the way the market has reacted?
Well, I think all of them have an effect. We cannot isolate it to any one of them. What happens is during a bear market, what happens is we are coming from a position where the market is overbought. It's on a very high level, and investor confidence is very high because people have been making, you know, higher returns every other day to a market which comes. So the first instance, for example, was the US dollar gaining in value. We are primarily an economy that is, we import a lot, right? So what happens is when the dollar becomes strong, the shilling becomes weaker, it means that our market will suffer. So that will tend to pull money out of our pockets, and because that happens, because it's a form of inflation, it will cause the market to start going down because there's less money for investment. So then the next thing that happened, we had Brexit. That also had an effect on our market because, you know, this also brings a bit of a negative. Foreign investors who invest in our market stay away from the market. Less buyers. If there's more selling than buying, it will happen. Then again, we had the interest rate capping. That fear now sets in. So now we are at the level we call despondency. People are really afraid of the market. Those ones who are the 1% who are contrarian, who you know, sit down and look at it and realize, look, these are external factors. Companies are still doing well, are probably going to make a lot of money buying.
So when you look at all the counters, I mean, where do you think investors burnt their fingers most, and where do you think they went to the bank smiling?
Well, I think they will definitely burn their fingers on most of what we call growth stocks, because those are the ones that will be caught in a situation where they were on a growth stage, and then, you know, things happened. For example, if you look at the banking sector, we have those that are defensive, and we have those that are very strong growth. And so you'll find that those banks that, particularly the locally owned ones, lost a lot of value because of interest rate capping. You'll find that companies that rely a lot on, say, on infrastructure continued to do very well and tended to be defensive. Things like KPLC and Kengen and people like Bamburi Cement, who would be supplying a lot of the cement to the infrastructure projects, will tend not to be hit as much as companies that will tend to be more cyclical because of that.
Going into the year 2017, what are your projections?
Well, my projections are...
And also bearing in mind that we are heading into the elections.
Well, interestingly, the last two elections, we have seen shares go up the year before or in the run-up to the elections. This is because investors are becoming more sophisticated. And so a lot of investors, especially the institutional investors and the foreign investor and the high net worth investor, they know that when the market is down, they look at fundamentals. If companies have good fundamentals, they know after elections they will come back. So they buy when they're low. So we tend to see that buying activity causing the market to go up. as we run up towards the election. And then at the end of at the tail end of them going up, then you see the rest of us after elections, because we feel the confidence is back, we all run to start buying when they're already high. So I think investors right now should be contrarian and buying heavily, so that when the market goes up, they're in a very good place.
I hope they have listened to you. They're going to
I do
act.
hope so, yes.
Thank you very much, Samuel, for joining us here.
Welcome.
Samuel Gishohi, Business Development Manager at NIC Securities, joining us here to help us understand the fundamentals that shaped the market in the year 2016. You're watching the Trading Bell.
To invest in treasury bills and bonds, one has to open or needs to open a CDS account with the Central Bank of Kenya. And once you do that, your account will be linked to your bank account. And then from then on, you can now use your broker or a bank to be able to apply for the bonds when they are being issued by the government. But the bonds will give you coupons twice a year, which means every 6 months you will get an interest coupon, and that is the way you earn your money from the bonds.
Well, and with a history fact, we come to the end of the Trading Bell for this week and for the year 2016. Many thanks indeed for being part of us. For any queries, comments or compliments, our SMS line is 22162. Remember to start with the word BIZ, that is B-I-Z. Our Twitter handle is at the Trading Bell. And of course, if you want to be part of the discussion, our Facebook page is the Trading Bell TV show. Our hashtag is at the Trading Bell. And if in case you want to get in touch with me, my Twitter handle is at O'Brien Kimani. On behalf of the entire Trading Bell crew, we take this opportunity to wish you happy holidays. Until next year, have yourself a prosperous and a profitable 2017.